Most retail investors don't lose money because they're unlucky. They lose money because they're playing a game they don't fully understand. They buy when things feel safe. They sell when things feel scary. And without realizing it, they end up doing the exact opposite of what actually works. In this video, we'll break down why that happens, and more importantly, how to stop falling into the same trap. Most retail investors think investing is simple. Buy a good company, hold it for the long term, and if the price drops, just buy more. It sounds logical, but this is exactly where most retail investors go wrong. The market isn't just numbers, it's behavior. It's driven by greed, fear, liquidity, and timing. And if you don't understand these forces, even a good decision can still lead to a bad result. The first mistake is buying at the wrong time. Most retail investors don't buy early. They buy when things already look good. When the price is going up, when the news is positive, when everyone around you is talking about it, that's when it feels safe. But in markets, what feels safe is usually expensive. By the time you enter, you're not early anymore. You're the liquidity for smarter investors to exit the trade. The second mistake is holding losers for too long. When a stock drops, most people don't respond logically. They respond emotionally. They tell themselves, "I'll just wait until it gets back to my price." But the market doesn't care what your price was. If a stock drops 50%, it doesn't need 50% to recover. It needs 100%. Now, let's look at a real example. Nike reached an all-time high of $179 in November 2021. By April 2026, it had fallen to around $43, a drop of about 76%. To get back to that previous high, the stock would need to rise more than 300%. That's not a small bounce. That's a massive move. And most stocks never get there. The third mistake is not understanding how markets actually move. Most people think price moves because of good companies and bad companies. But in reality, price moves based on where money is flowing, who is buying or selling, and the overall direction of the market. You can pick a strong company like Apple, but if the overall market is going down, that stock will usually go down with it. So how do you fix this? You don't need more indicators. You don't need more news. You need a better framework. First, think in probabilities. The goal is not to be right on every trade, but to manage risk and protect capital. Second, respect the trend. Markets move in direction, and fighting that direction usually leads to losses. Third, detach from your entry price. The market doesn't care what you paid. The only question that matters is this the best place for your money right now? Most retail investors don't fail because they're not smart. They fail because they don't understand the game they're playing. But once you understand behavior, timing, and risk, you stop reacting and start thinking. In the next video, we'll break down one of the most dangerous traps in investing, the break-even trap, and why it quietly destroys portfolios. Subscribe if you want to understand how markets really work.